Welcome to the Defence Property Podcast, the podcast where we talk about all things property investing and real estate for Australian Defence Force personnel. Whether you're looking to build and scale a property portfolio or relocating across Australia, we've got the insights and tips for less stress and more success. Let's dive in.
Welcome back to another episode of the Defence Property Podcast. No special guest today, just flying solo. And today we're talking about why house and land packages or purchasing off the plan is an inferior strategy to buying established property and some of the pitfalls or risks associated with house and land packages and off the plan. Kick things off, understand the difference or where the value is in property investing, which is essentially the land content of the property. So we know land appreciates over time and dwellings or houses, bricks, timber, electrical deteriorate or lose value. And we know that's factual because the ATO will allow you to claim the loss of value of the dwelling as depreciation over a certain period of time. Hence, as a property investor, we always get a depreciation report and claim that through our accountant who guides us, claims that depreciation each tax return we lodge. So dwellings depreciate, land appreciates. That's key to take away. So when we're purchasing, we always want to look at the percentage of the value of the purchase price that is land content and dwelling. And it's not that easy to just draw up and understand. But when we look at a brand new house and land package or say a brand new townhouse, there's very minimal land content. Many new estates, land parcels are coming out in 250, 300 square metres. So of $1 million budget, 70, 80% of it might be the actual dwelling value on purchase, and then only 20 or 30% could be the land content value. If we then look at another example and we go to the eastern suburbs of Sydney, looking at many houses that are unrenovated, are really old and require huge renovations, both structural and cosmetic, to make them livable if they're from their original condition, because there's a complete scarcity of new land there. So we can't buy new land to build, so we've got to buy an established dwelling in fully built out suburbs. If the house is to the point where it needs to be knocked down and rebuilt, you can make a strong argument that 90, 95, 99% of the purchase price of that property is land content. And 1%, 2%, whatever, depending on the condition of the dwelling, is the house component of it. So a very large portion of our budget has been allocated to the component or the land that goes up in value, and a very small portion has been allocated to the building, which depreciates and loses value, which is obviously far superior than buying a brand new house land package where a large portion is the dwelling, which leads us into supply and demand, which determines price movement of any asset. If we're looking at the supply metrics of, say, the eastern suburbs of Sydney, there's no new land estates there. There might be a couple of very small pocket infills, but the only way that they're building these suburbs is by going up. Hence why units are generally inferior to houses and underperform. But there's no new large subdivisions with 500, 1,000 master plans of new parcels of land being released. So there's a complete scarcity of land, hence why we need to knock down. And that scarcity means there's an extremely low amount of supply. Then take it out to far western Sydney. There's generally a lot more land available where developers can come in and purchase large parcels, cut it up into 2, 5, 1,000, 2,000 parcels of land. And that is a saturation of supply, and supply is the enemy of growth. So that saturation of supply in that area is going to have downward pressure on the price or the performance of our investment. So it's a far inferior strategy when you look at the supply and demand metrics of a suburb. And we can look these up live and get a really good reading and understanding of every suburb in Australia. And you can make an argument that a rising tide lifts all ships. And even if you do purchase a house land package, it goes up in value. Say Victoria goes up 20 or 30% over 3-4 years, and you buy maybe a house of land in that, you're generally paying a premium for it to be brand new and shiny, and that premium is factored into the price that you've paid. And in the same period of time where an established property grew 20 or 30%, you may get 10 or 15%. So yes, the rising tide lifts all ships and drags your house and land up, but if it's underperformed against other assets in the area, your strategy is inferior. And if we further quantify the eastern suburbs versus western Sydney example, the eastern suburbs is more desirable, and the complete scarcity is what causes the Waverley LGA or local government area to have a median house price of 4.8. was no 4.8 million, that is, and there was no magic wand that come down and just said the eastern suburbs is more desirable. People want to live there and they're willing to pay more for the property in that area. It has a median house price of 4.8. If we go out to Penrith and look at the median house price, it's approximately sitting in the 1.2 range. So it's much cheaper and much more affordable, but it's because it's much lower. Again, there was no magic wand. It was lower because there's less demand there and more supply is coming to those markets, which is going to slow the growth compared to an area where there's complete scarcity and no supply. So understanding our supply and demand metrics of a suburb is going to help our performance of our assets. Then we're paying the premium for the brand new house or brand new unit, which is like paying a premium for a brand new car. The minute we drive it off the showroom floor, it's not new anymore. So we know that it's lost value the moment we drove it off the showroom floor, maybe 10%, 15%, as it's now secondhand because you own it. And to sell it, it's secondhand and you're competing with the open market. Property's no different. We buy a brand new property and we pay a premium for it to be new and shiny, but the moment you've lived in it, it's not new and shiny anymore. You want to resell it to release some, pay out the loan and release the asset from your portfolio. You're competing with the open market. We're then looking at comparable sales to understand how and what is this property worth. So when we're buying a property for a portfolio, regardless of where we're finding that property, we always want to look at the comparable sales in the market of what it's actually worth, not a price tag that it comes with off the plan. So regardless buying off the plan or new house and land from a developer or builder, we need to compare it to the open market and the comparable sales in that area to get an understanding of its true value. And then finally, many companies that are selling house and land packages or units off the are marketing companies and they're working for the developer to sell these properties. So they actually remunerated 30, 40, 60, 70, 80,000 to sell these properties. So that is not free money that they get for marketing and selling the property. That is money that is factored into the purchase price. So when we put all this together, we're paying a premium for it to be new and shiny. We're paying a premium for a marketing company's commission paid from the developer to the marketer. And then we're in a market that's inferior supply and demand metrics. Put it all together and we've got a far inferior strategy to purely picking a suburb and an asset in an area that is supply and shortage, demand's evident. We have through the affordability index, cycle timing, and out of all of Australia, 17,000 suburbs, we can pick the right one for the right strategy that fits client profile. We are not a marketing company that is being paid to sell a certain stock and therefore not considering supply and demand metrics, but only considering where can I find stock where I'm going to get paid a commission. Very important to understand this. Any questions or queries, please reach out. Kane from discoverbuyersagency.com.au. Thanks for listening.